Welcome to RagingFX's Forex trading course, week number 4. If you'd like more information about this course, please visit us at RagingFX.com. Today we'll be covering part 1 of our Forex risk management segment. So here goes. Fortunately for RagingFX subscribers, our algorithm does most of the heavy lifting. As a subscriber, all you need to do is answer a key question and learn a couple of tips and tricks that can help keep your trading on target. Here's the key question. What is your risk profile number? Although no one likes to lose money, the reality behind Forex trading is measured on a net basis. There are and should always be wins and losses. The goal is to net a positive balance on a consistent basis by keeping to a strict risk management strategy. So what do the pros do? They follow a 3-step process to determine their personal risk profile. Here's how you can do the same. Step 1. Select the amount below that you're willing to lose in one day. $10, $50, $100, $300, $500, even $1,000. A loss of this amount should feel like pocket change, not your last dime. Step 2. Now take the amount you selected and divide it by the total balance currently in your Forex account. Step 3. The percentage result becomes your personal risk profile number. Memorize it. Let's take a look at an example. Suppose you open a live Forex account today with a $10,000 deposit, and previously you decided that the most you were willing to lose in one day was $300. Knowing this information, what would be your risk profile number? Right. Your risk profile number would be $300 divided by 10,000, or 3%. This number, 3%, will define your trading success from A to Z. It's a number that you should always keep in mind every time you place a trade. It is your personal passport to growing your account on a sustainable basis. It also happens to be the number one item traders tend to forget when in the heat of a fast trade. They get all caught up in the excitement, lose their concentration, and start the infamous backtracking by averaging down. And before they know it, they exceed their daily loss limit. It happens, even to the pros. Now that you have a risk profile number tattooed on your forehead, we hope, how should you use it? Step 1. Check your account balance at the beginning of the week. Maybe you made some money, maybe you lost some money. Whatever the amount of equity currently in the account is the number you're looking for. Step 2. Multiply this amount by your risk profile number. Step 3. Voila! Use this revised number to calculate your trade sizes for the week. As you can see in this next example, if I increase my account balance to $12,500 from $10,000, my new daily maximum loss is no longer $300, but 3% of $12,500, or $375. That means I can trade more than the week before. The reverse is true too. If I lost money last week, then my maximum daily loss decreases and I trade less. The key point is that you can trade larger sizes as your account balance grows and vice versa. Cool. Now let's use what we've learned and apply some tips from the pros. If you don't have much time and need to quickly determine your daily maximum loss, here's what you can do. Use the 3% for $300 for a $10,000 account info as a benchmark. It's like a point of reference for easy extrapolation. So, if you have a $1,000 balance in your account, your maximum daily loss is $30. For a $20,000 balance, which is twice the 10, it would be twice the 300, $600. Pretty easy. And for a $100,000 balance, the maximum daily loss would be $3,000. Great. Next up, let's convert your risk profile number into the jargon currency that pro traders use to measure their daily trading progress, called pips. First, what's a pip? In this example, pips represent the smallest price movement from the 4th decimal. Hence, if the euro dollar was priced at 1.1801 and it were to move up 1 pip, the new price would be 1.1802. For this specific pair, the euro dollar, a 1 pip move represents a gain or loss of $10. Fair enough. So if I use the table here, I can easily see how a 10 pip price move equals a $100 gain, and that a 100 pip price move would render a $1,000 profit. Armed with this information, let's convert our $300 maximum daily loss number into pips. So if 1 pip is $10 and 10 pips equals $100, how many pips would equal $300? Right, 30 pips. That means that your maximum daily loss of $300 is equivalent to a net 30 pip price move of the euro dollar. There's one more detail to take in, that is trade size. And when referring to a 30 pip price move, you also need to specify the size of the trade. In our case, that size is an easy number to remember. It's 1, and is referred to as 1 lot. We'll look into lots later, but for now, it's just a term used to measure a trade order. You can have 1 lot, half a lot, 2 lots. If you've traded shares before, it's the same as if you were speaking in terms of 1,000 shares or 500 shares or 200 shares. It's the same concept, same idea. So let's summarize everything that we've put together here into one statement and see how it sounds. A $300 maximum daily loss is equal to 30 pip price move of 1 lot trade of the euro dollar. That's a very important statement, and hopefully you can understand that. Even if you do not totally understand everything we have covered, memorize the above statement. Then after a little practice trading, all the pieces of the Forex puzzle will start to make more sense. Let's read off some more statements that you should commit to memory. For a 1 lot trade of the euro dollar, okay, a 3% maximum daily limit is equivalent to setting a stop loss 30 pips away from my entry level. As a Forex trader, your risk tolerance for 1 day of trading is a net total of 30 pips. The maximum trade loss exposure allowed at any one time is 30 pips. At a 30 pip maximum daily loss limit, I can place 2 trades at the same time that risk 15 pips each, or 3 trades that risk 10 pips each. We recommend that you memorize this slide. There's a lot of important statements here that you should understand. If you read them a few times, they'll start making more sense. Finally, let's take a look at how one can vary trade size versus pips. On the left table, we kept the pips number the same and changed the trade size. On the right-hand table, we kept the trade size the same, 1 lot, and then changed the pip value. So you can see here, here's our statement, 300 max daily loss, 30 pip price move of 1 lot of euro dollar. I could have 1 trade of 1 lot of euro dollar risking 30 pips, or I could have 2 trades of half lots each risking 30 pips, 5 trades at 0.2 lots risking 30 pips, and 10 trades at 0.1 lots risking 30 pips. Then there's also the maximum number of trades allotted at any one time. I could have 1 trade of 1 lot of euro dollar risking 30 pips, or I could have 2 trades of 1 lot each risking 15 pips each. All in all the trades that are listed here on this page, all the trades shown equate to a maximum daily exposure of $300, and that's your daily maximum daily loss allowance. And that's the whole point of this exercise. Thank you for your time. We hope this video clarified some key distinctions for you. If you have any questions, please post them below or send us an email from our website, RagingFX.com. Thank you.